Welcome to the Deep Dive. Today we're looking closely at the investment operating system of someone truly remarkable, Li Lu.
Ah, yes, Li Lu. He's, often called the Chinese Warren Buffett.
Exactly. And maybe more telling, one of the very few people Charlie Munger ever trusted with his family's money. An outside manager, no less.
And that Munger endorsement, well, as our sources point out, it's basically a character reference from a giant in the field.
It really is. We're getting into this using the material you've shared, which is essentially a deep deconstruction, even a simulation of how he thinks and invests.
So our mission for you in this deep dive is pretty straightforward.
We want to unpack what makes Li Lu's system, his operating system, really tick.
Right. How did his life experiences, which are pretty extraordinary and go way beyond finance, how did they actually shape his investment edge?
And, crucially, what are the lessons you might be able to take away from all this?
Let's start right there, with his life. It's foundational. Li Lu was born in China in 1966.
In his early years, well, they gave him a perspective most investors just don't have.
Definitely. He survived the Tangshan earthquake in '76, a massive disaster.
And then, just over a decade later, he emerged as a key student leader during the Tiananmen Square protests in 1989.
These weren't just, events he read about. They were crucible moments. They forged his worldview.
It's quite a leap, isn't it, from political activists facing that kind of turmoil
to becoming this celebrated value investor after he got to the U.S. That's the trajectory.
He co-founded Himalaya Capital in 1997, built it around long-term value, high-quality companies.
Primarily focused on Asia and North America.
And that Munger connection keeps coming up. It's key.
It really is. Munger didn't just invest his family's money. He saw something truly exceptional, calling him the Chinese Warren Buffett.
That signals more than just investment skill. It signals character, intellect, that deep intellectual honesty Munger prized so highly.
Exactly. Munger always stressed that broad understanding, that honesty. Li Lu clearly had it.
So here's the central question we're wrestling with in this deep dive. We know the influences Graham, Buffett, Munger. We know the focus on intellectual honesty, waiting for the fat pitch.
Yeah, the standard value playbook stuff. But what's the unique alchemy here?
How does he hold investments with such incredible conviction, especially in a market as complex and, frankly, opaque as China can be?
And how did that tumultuous history, those early life experiences, translate into a tangible investment edge?
Okay, so based on the sources, the core thesis, his alpha, seems to be this rare synthesis.
It's the deep value discipline, yes, absolutely. But it's combined with this profound philosophical patience.
A patience forged by adversity, right? And a real sense of history.
Plus, you have to add that unique cross-cultural fluency, understanding both East and West deeply.
Okay, let's explore that synthesis. It sounds like this blend lets him see opportunities, long-term compounders where others just see risk, especially in Asia.
Precisely. Think about surviving the Cultural Revolution, the Tangshan quake, Tiananmen. That gives you a visceral feel for catastrophic risk, for the absolute need to preserve capital.
So when Benjamin Graham talks about margin of safety, for Li Lu, it wasn't just an academic concept.
Not at all. Our sources suggest it landed much deeper. It was a lesson etched into him by experience, learned the hard way.
He has that famous quote, "In my view, the biggest investment risk is not the volatility of prices, but whether you will suffer a permanent loss of capital."
And the sources really emphasize that. It's not just a saying for him, it's a creed. Etched by experience is how they put it.
His academic path is interesting too. Physics first.
Yeah, physics, then economics. And then at Columbia, he did a JD and an MBA simultaneously.
Wow. That physics background. Maybe that helps in thinking about systems, fundamental laws.
Could be. And the legal training, the JD, that sharpens due diligence, skepticism, the ability to really pick apart complex situations, contracts, management statements, spotting potential fraud.
It's a genuinely multidisciplinary foundation, not your typical finance path.
Definitely not. And it likely shapes how he tackles problems.
Okay, so here's the plan for this deep dive. We're going to dissect the foundational pillars of his system.
Then we'll stress test it, look at real examples, see how it holds up.
Explore its limits too. No system is perfect.
And finally, distill it down. What's the single most potent lesson for your investing approach?
All right, let's start with those foundations. Pillar number 1, his worldview. The lens he uses.
He sees markets as, learning systems, often irrational in the short term, very much like Graham's Mr. Market.
He's quoted saying, "The existence of the market is to help these real value investors, not to guide you what to do."
So volatility, that's not risk to him, it's opportunity.
And his definition of wealth, it feels very grounded, not just money in the bank.
Right. True wealth is your share of purchasing power, best held through owning productive assets, shares of the most dynamic companies.
Static wealth, cash, it just sits there, can't compound.
And that focus on purchasing power feels particularly relevant given his background, witnessing China's transformation, inflation, instability.
He also seems to have this deep, long-term belief in the modernization path of Asia, particularly China. His writings touch on this.
He sees value investing as universal, applicable wherever you have private enterprise and markets. He's talked about potential for a sustained win-win in China.
If certain systemic stabilities hold, right, he's not naive.
Absolutely not. Tiananmen taught him progress isn't guaranteed. It can be disrupted. His risk assessment goes way beyond just economics. He sees the predicaments of our era.
So his definition of risk boils down to that one thing: permanent loss of capital.
Exactly. Price drops are just noise, potentially opportunity. Permanent loss is the thing to avoid.
And under this worldview pillar, you really see the Munger influence. Human nature, biases.
Huge influence, that emphasis on intellectual honesty, knowing what you don't know.
It's more than just an investment virtue for him, isn't it? Feels like a countermeasure.
A countermeasure to the dogmatic thinking, the ideological possession he likely witnessed growing up. It keeps him flexible, less prone to confirmation bias. It's deeply personal.
Okay, that's the worldview. Let's move to pillar 2. The non-negotiable filters. His investment criteria.
First up, business quality and moat. Absolutely fundamental.
He's looking for high-quality companies with substantial economic moat, durable advantages, strong fundamentals.
That's the bedrock for long-term compounding. Can't build wealth long-term without it.
Next filter, trustworthy management. This seems critical for him.
Extremely critical. Finding trustworthy people, leaders who are both competent and honest, they're the stewards of capital.
And the sources suggest this filter is maybe even stronger for him because of his background, where trust might have been scarce.
That and his legal training. It gives him a sharper lens for assessing governance, agency problems, really scrutinizing leadership beyond the surface level.
Then margin of safety. The classic Graham idea, but still core.
Paramount for avoiding that permanent loss. He needs a sufficient safety margin.
So buying undervalued businesses, or maybe more Munger-like, wonderful businesses at fair prices.
Exactly. You see that evolution. From Graham's cigar butts, cheap stocks relative to assets towards Munger's focus on quality. Shows adaptability.
He also looks for long-term growth potential, companies that can really run.
Yes, businesses with great growth potential, generating high returns on capital over the long haul. Companies that can last for decades.
True wealth comes from that compounding, doesn't it?
That's the engine. And maybe that focus on enduring constructive enterprises is also a contrast to the destructive forces he saw early in life. Just speculation, but it fits.
And underpinning all these filters, the circle of competence, staying within it.
Rigorously, knowing what they understand, what they do not, and the boundaries of their knowledge.
The warning is stark. If you stray, market takes you to the cleaners.
Because that's how you risk permanent capital loss. Going outside what you truly understand.
Okay, worldview, filters. Now, pillar 3. The intellectual lineage, the source code for his thinking.
Obviously, finance starts with Graham, the foundation, Mr. Market, margin of safety, the intelligent investor.
Then Buffett. The evolution towards quality, moats, compounding.
That 1993 Buffett lecture at Columbia is cited as really pivotal for Li Lu, and Himalaya capital structure mirrors Berkshire in many ways.
But Munger, that seems like the deepest influence.
Profound intellectual honesty, worldly wisdom, mental models, biases, the too hard pile.
The relationship was incredibly close. Mentor, client, almost father-son-like.
Li Lu himself said Munger made value investing possible globally. High praise.
And through Munger, he got that deep dive into psychology, cognitive biases.
Right. Intellectual honesty is the defense mechanism against those biases.
But his connection to history and philosophy,
Yeah.
that's different. It's lived experience.
Cultural Revolution, Tangshan, Tiananmen, these built resilience, a long-term view, an understanding of socio-political risk that you just can't get from books. It's etched by life, as the sources say.
His own writings show this too. Moving the Mountain, his essays on China, grappling with big historical forces.
And he emphasizes learning broadly. History, poetry, literature. synthesizing that with Eastern perspectives too, maybe Confucian ideas about long-termism, societal order.
And finally, that unique academic mix: economics, law, business.
That JD-MBA combo from Columbia provides analytical frameworks for markets, regulations, contracts.
Plus that physics grounding, thinking about systems, and the legal mindset again.
Forensic detail, skepticism, deconstructing information, due diligence. Hugely valuable for avoiding pitfalls, especially fraud.
Okay, pillars laid out: worldview, filters, lineage. Now let's put the system under stress. Theory meets reality.
Right, and this is where that philosophy seems to create his distinct temperament.
It's counterintuitive in many ways.
Absolutely. Those early adversities built resilience, patience, a long-term perspective that just dwarfs typical market cycles.
Market volatility must seem less terrifying compared to existential threats.
You'd think so. It fosters what some call an anti-fragile temperament, clarity when others panic.
In that core value belief price versus value decoupling, Mr. Market gives him the scaffolding to act countercyclically.
He says it clearly. The mere drop in stock prices is not risk, but it is an opportunity. Buy when others are fearful.
Plus, that intellectual honesty, staying in his circle, keeps him out of speculative manias.
Allows for rational assessment, even when emotions are swirling all around.
And the long-termism isn't just a preference. It's baked into Himalaya capital structure.
Some of our holdings date back to 20 years ago, he said. That structure dampens reactions to noise, prevents style drift. It's a deep commitment.
He fully embraces Munger's swing hard at fat pitches.
Meaning concentrated bets on the best ideas. It takes discipline to wait for those pitches.
And courage to swing hard when they arrive, often against the crowd.
Once in a while you will find a fat pitch, then you swing hard. A concentrated portfolio means extraordinary conviction. And diligence.
And Munger himself was a living example, wasn't he? Lifelong learning, steadfastness.
Right. Munger continued to read, stayed disciplined, a reinforcing model.
Okay, let's talk about a concrete example. The iconic investment, BYD company.
Ah, yes, the Chinese battery and EV maker, legendary, partly famous because Li Lu introduced it to Munger and Buffett. Berkshire took a big stake.
And Himalaya still holds it.
Still holds. A cornerstone. Let's apply the pillars. Worldview.
Dynamic company, transforming China, key industry, enabling purchasing power, right at the intersection of huge trends: energy transition, China's rise, battery tech.
This cross-cultural fluency and understanding of China's path were critical there. Filters.
Business quality moat. BYD had early tech leadership, that vertical integration, a powerful advantage. Management.
Deep dive on founder Wang Chuanfu, assessing competence, drive, trustworthiness. Using that sharp filter, margin of safety.
Berkshire got in around 10x earnings. Li Lu was likely earlier. Saw value versus the growth potential, long-term growth.
Clearly saw the EV wave coming and China's role. Circle of competence.
This was squarely in his wheelhouse.
Yeah.
Deep understanding of Chinese industry, manufacturing, government context.
Yeah.
A real edge.
Intellectual lineage, classic evolved Buffett Munger. Wonderful business, long runway.
But the temperament. That's where BYD really shines as an example.
Extreme patience, conviction, holding for 22 years.
Through massive drawdowns. Stock down 50% 6 or 7 times, down 80% once.
And he held. His quote is amazing. We did not feel very stressed because we knew that it was creating new value every year.
That's looking straight through volatility to the business. Understanding growth stocks swing wildly.
And his definition of risk permanent loss let him distinguish panic selling from real business problems.
Swinging hard, BYD was clearly a fat pitch for him, a major portfolio position.
And introducing it to Berkshire shows his confidence, his unique bridge role.
Okay, but systems have limits. Let's look at an exit. Micron Technology.
Right, the U.S. semiconductor company.
Yeah.
Bought in 2019-2020, reportedly with Monish Prabrai. Value thesis, cyclical upswing.
But they exited entirely in early 2023, around $58, $64 per share.
And the stock then went up significantly, about 32% more soon after.
So analysts speculate the thesis got disrupted. Geopolitics, industry shifts, like AI.
That seems to be the thinking. So what does selling and missing that subsequent upside tell us?
First, strict thesis adherence. If the fundamentals change, he gets out, even if it means leaving gains behind. Risk management first.
Exactly. Primacy of capital preservation over FOMO. If new risks emerge or the safety margin erodes unexpectedly, he's willing to walk away.
It highlights a potential vulnerability, though, right? The system relies on a somewhat stable game. Big, unpredictable shifts.
Like export controls, major policy changes. Those can invalidate the original analysis. especially in a complex, sensitive sector like semiconductors.
Maybe it pushed the boundaries of his circle of competence,
Yeah.
with the rules changing fast.
Quite possibly the GPS Act, expert controls. It made semis even more complex and geopolitically charged.
And it shows he's not a market timer. The exit was about fundamentals or risk changing for him, not about predicting the peak price.
Big difference from BYD, where the thesis remained intact in his view. For Micron, it seems it fundamentally shifted.
The Protégé collaboration is interesting too. Shows the value of a sounding board. But even combined brain power doesn't guarantee perfect exits in volatile areas.
And selling Micron while holding other U.S. tech, or BYD, it shows his decisions are granular. Company-specific, context-specific, not broad macro bets.
Which brings us nicely to part 4, limits and lessons. Let's challenge the model.
Let's red team it. Where could it break? Severe U.S.-China geopolitical rupture seems like a major one.
His China expertise could become a liability. Capital controls, forced sales.
Potentially. The bridge status becomes risky. His edge in understanding China might be a blind spot if the game changes fundamentally beyond economic logic. Past experience might not cover all future risks. Brittleness there.
What about long value droughts, when growth or momentum just runs and runs?
His core is value. Sustained underperformance tests LP patience. That's a business risk for the firm, even if his own patience holds. LPs might not wait forever.
Rapid tech disruption outside his circle. AI, quantum, symbio.
Steep learning curves there. Hard to gain conviction quickly. His intellectual honesty means he'd likely pass, which is right, but he could miss huge shifts or misjudge threats. The circle is strong, but it's also a boundary. If value moves outside, the opportunity set shrinks.
Unforeseen political or regulatory shifts, especially in China.
Centralized systems mean sudden changes, crackdowns. His understanding helps, but can't perfectly predict autocratic moves that defy economic logic. Some shifts could be devastating, even if he accepts macro risk generally.
Concentration risk plus a black swan.
If a core holding gets hit by something truly catastrophic and unforeseen, the low number of holdings means a bigger portfolio impact.
And finally, the Munger succession. Losing that intellectual partner.
It's significant. The dynamic, the stress testing, its absence could subtly change things over time. He has to fully internalize and evolve it alone now.
Let's try a simulation. How might Lei Lu analyze ASML, the Dutch semiconductor equipment giant?
Super complex case. EUV monopoly, capital intensive, R&D heavy, geopolitically charged. Okay, pillars. Worldview.
ASML is critical to global tech, enables purchasing power via computing advances, heart of modernization. Fits his view of dynamic, important companies.
Business quality moat. Extraordinary. Near monopoly in EUV. Strong financials. Growth. Assessment. Exceptionally high quality, powerful moat. Management.
Huge diligence needed here. Leadership, R&D commitment, execution, integrity in a complex global setup. His legal skepticism would be on high alert. Assessment needs intense scrutiny.
Margin of safety. Trades at high multiples. High growth baked in. This is tough.
He'd be wary of overpicking. Needs confidence in intrinsic value in a fast-moving esoteric field. This really tests the framework's ability to handle deep tech.
Long-term growth. Secular tailwinds are massive. AI, HPC, 5G, IoT assessment, excellent durable growth potential, assuming geopolitics don't break things.
Circle of competence. Okay, this is the big one for ASML.
Huge GE stress point. Deep physics, engineering complexity, plus layers of geopolitical uncertainty.
His approach. Devote enormous amounts of time. Ask fundamental questions. Why buy? Could customers manage without them? Answer for advanced chips. Mostly, no.
If he couldn't get high confidence on the tech risks, moat sustainability, geopolitics, it lands in the too hard pile. Gotta know the limits.
He'd analyze the geopolitics acutely, though, using that east-west understanding. Maybe see indispensable strategic value or maybe unacceptable risk.
Temperament. If he did get conviction after all that work, he'd likely hold through cycles, trusting the long-term value creation.
So, the ASML simulation conclusion. Attracted by the moat and growth, definitely.
But the decision boils down to, can he bring it fully inside his circle of competence? The tech, the geopolitics, it's a very high bar.
Investing would signal a big evolution of his circle. If not, admire from afar, respect the boundaries.
Which leads us to the final part, the core distillation, the one big lesson.
Synthesizing it all. Robust pillars, yes, but unlocked by that rare temperament. Patience, conviction, forged in adversity.
Allows identifying and holding those fat pitches, even in complex places like BYD. But crucially, understanding the boundaries. Geopolitics, momentum, tech he doesn't grasp but deeply.
Acknowledging limits is a feature, not a bug. The circle, the too hard pile saying, I don't know. Self-awareness is critical.
So the single most potent lesson might be this. Cultivate unwavering conviction, but root that conviction in truly deep independent work, rigorous work, done strictly within a self-aware, tightly policed circle of competence.
And then marry that conviction with profound, almost philosophical patience.
Comes right from his emphasis on deep understanding, intellectual honesty, knowing limits, holding for decades.
Why is that the most powerful lever?
Because in this world of information overload, noise, short-termism, the ability to genuinely understand a few things deeply.
Honestly admit what you don't understand and avoid it wisely.
And then act decisively and hold steadfastly based on that understanding. Insulating yourself from the noise, that's the rarest source of sustainable alpha.
Depth over breadth, unparalleled depth, unwavering courage in just a few opportunities.
It's the antidote to behavioral errors, the driver of long-term compounding.
But it's more than just process, isn't it? It feels like it's about character.
That patience, that conviction, it seems forged by life, by temperament, as much as by intellect. Internalizing it requires character development.
And maybe its power is even greater today in this complex, fast economy.
Deep expertise plus philosophical patience lets you exploit the inefficiencies caused by info overload, short attention spans. It's a counter strategy.
It demands depth. And that depth enables the conviction to let compounding work over the very long term.
His story really reminds us that edge often comes from that mix. Analysis, patience, and deep self-awareness. Understanding the world and yourself.
And the real challenge, as always, isn't just hearing these ideas. It's actually living them, embodying them in your own decisions. So the final thought for you. How can you start cultivating that kind of deep understanding? Build that self-awareness, and find that unwavering philosophical patience in your own investing or maybe other parts of your life. Something to think about.
That wraps up this deep dive.
We'll catch you on the next one.